Good afternoon, everybody, and thank you once again for joining us. This is Ian here from SOFTRAX, and I'm joined today by Tony Sondhi of A.C. Sondhi and Associates. We'll just give everyone a few more minutes to dial in. We're still waiting on a few people, but we can start pretty promptly at 1. I just wanted to make the announcement one more time that this will be a CPE eligible webinar. So if you are interested in CPE credit, we'd ask that you please make sure to stay the entire duration of the 1-hour presentation, and also to answer all 3 of the polling questions that will be dispersed intermittently throughout the presentation. You can do so with the GoToWebinar console. If at any point you have any questions, then please feel free to use the GoToWebinar console and ask those questions. We'll be sure to either answer them as they come up, or we'll follow up after the fact and make sure that every question does receive an answer. So, like I said, we'll just wait 1 or 2 more minutes just as some more people trickle in. And we're really glad that you could join us, and we're excited to present to you on implications for variable revenue streams. So thank you very much. Hello again, everybody. It looks like we still have some people trickling in, but it may be worth it to get started. So I'll just say once again before we start, if you're interested in CPE credit for this webinar, it is a CPE eligible webinar. Please make sure to stay the entire duration and to answer all 3 polling questions throughout the presentation. So Tony, if you're all set, I think we can maybe do introductions, and then that'll give some people a little bit more of a chance to come in, and then I think we should be good to go.
Sounds good.
All right, excellent. So like I said before, I'm happy that you guys could all join. This is Ian Mickelson, Marketing Coordinator with SOFTRAX, and I'm joined today by Tony Sondhi. So we'll be presenting, and Tony will be primarily presenting on the implications of COVID-19 on variable revenue streams. Just before we start, a couple of quick words, about SOFTRAX, about A.C. Sondhi. SOFTRAX is a software company. We're a producer of revenue recognition and complex billing automation solutions. We have a long track record in the industry of helping companies to automate those issues, to save time, to save cost, to save risk, alongside revenue recognition and billing operations. And of course, financial reporting is certainly part of that. So Tony Sondhi is, he's been a partner of ours for years. He's been working with us for years, and we're thrilled to have him back. Tony, I guess I'll let you introduce yourself if you'd like.
Thank you, Ian. And as you said, yes, I have been partner with SOFTRAX for a very long time. I began quite a while ago. I've done a fair amount of work with you folks and glad to be here today as well. I run a financial consulting and investment advisory firm. I came to financial reporting through financial analysis. I've developed analytical techniques that are based on financial information. And then over the years, I've spent a lot more time with financial reporting and more than 20 years as a standard setter as well with various bodies. Most recently, I finished a 16-year stint with the Emerging Issues Task Force. And I've spent a lot of my time working on revenue and leases, and I'm glad to be here today. So shall we begin, Ian, with our first polling question? And as you get that up, I'll explain what it's all about.
Sure. So here it is right here, and I'll launch it using the console itself. So excellent. The question is confirm status on deal desk optimization.
Okay, so the deal desk, some people call it sales operations, some call it revenue operations. It's really where the sales team and the finance team get together. And the objective is to try to grow your revenues while making the experience really something worthwhile for your customers. I think of the deal desk as being the sort of a very critical nerve center of the company. And it's the hub where the IT, the sales, and the finance team work together. And what I'm just trying to find out is where your company is. You may not have a deal desk operation at all. Alternatively, you may have a very rudimentary deal desk operation. Generally speaking, what that means is that every so often the finance team will go over, somebody from the finance team will go over and talk to the sales team, or the sales team will send in a question, whether a particular term or condition in a contract is going to create issues. So that's sort of the second level, the rudimentary one. The third one is where you actually have a formal deal desk where you've scheduled periodically for the two teams to meet. And as I said, it should also include the IT, but it doesn't always do that. The fourth possibility is that you actually have a seasoned deal desk where the relationship between the teams is far more advanced and far more consistent and meeting on a timely basis and so on. And then finally, of course, you have a fully functioning deal desk. So you tell us where you are, and then we'll also, once we have a sufficient number of responses, we'll show you what our past history has been. Just keep in mind that the audiences are different. I've conducted this survey since January of this year in a large number of webcasts. There was a time when I was just doing one webcast a month, but in this COVID-19 period, I've certainly been doing at least 2, sometimes 3 of them a month. So we do have a fair amount of experience with this question. And we'll just let you know briefly what it looks like. So, and Ian, you can let me know when you have a sufficient number and you close the polling question.
Sure. I will go ahead and close it. We're at up above 90%. So I know that we've had technical difficulties in the past. If you're having technical difficulties, then please just let me know and you won't be penalized for that. But we do have most of our responses. So I will go ahead and close the poll.
All right.
So our previous results are now displayed here. Tony, it looks like for this time around, you may not be able to see these answers, but we have 34% answering that they have not started the assessment or that no deal desk exists. We have 24% who answered a basic setup, 21% who answered a formal deal desk in the early stages, 10% with a seasoned deal desk, and 10% fully operational.
Great. So that's good. It gives us a sense of it and gives people a sense of where they are relative excellence. So let's then move on. The next two slides are basically just going to tell you about some of my consulting services. One of those, of course, deal with the deal desk, and then the next one has to do with COVID-19 and the implications. So there, I can show you what the FASB and the IASB have said about the COVID-19 response and how it affects certain areas of financial reporting. And I can show you what implications or inferences you can draw from that. So if you have those kinds of issues, please feel free to contact me. And that should, Ian, allow us to get started with the formal part of the presentation.
Excellent.
And so our next slide will simply just mention these issues. We're looking at COVID-19. Ian and I worked on this, and we've designed this webcast to give you a sense of how COVID-19 might affect one aspect, and a very critical aspect. And what we settled on was the discussion around variable revenue streams. And last month, on the 28th of April, we conducted the first of these two webcasts, and we talked about one category of variable revenue streams. And today I'm going to discuss the other, and I'll tell you what those are in just the two are in just a bit. And we should then move on to the next slide, which tells us what some of the sources of variability in consideration are that would affect the amount that the seller is expected to be entitled to. Now, or expects to be entitled to. You'll notice that I'm citing paragraph 606.10, 32-6. 32, when the third string of numbers is 32, that always implies that we're talking about measurement. Please keep in mind that in financial reporting, you're normally concerned about three characteristics of every single item that you have in a financial statement. It's when, which is the timing or the recognition question. When should I recognize revenue? Second, the amount or how much, the measurement issue. And then the third is the uncertainty around the timing and the measurement, which normally is reported through disclosures. So we're always talking about recognition, measurement, and disclosure. Here in 32-6, the board has identified some of the possible sources of variation. So if you offer discounts, rebates, refunds, that's going to affect how much revenue you'll end up with. Because not everybody's going to take the discount, not everybody's going to be entitled to the same amount of the discount maybe. You can also have performance bonuses, performance penalties, price concessions, and sometimes analyzing price concessions is not straightforward. But the point is that here are some of the sources of variability in revenue streams. Okay, so whenever you have variable consideration, the next slide tells us that you have actually two different methods that you can use. Now, the first method, the short form title is the expected value method. And that expected value method is actually the sum of probability weighted outcomes. So if there's a 10% chance that 5% of your customers will take the full discount, 20% chance that they'll take 3/4 of the discount, and then the rest of them will take half of the discount. Then you take those three, apply the probabilities, the 5%, 10%, etc., and the remainder, or whatever numbers I used in my earlier explanation, and you take that and apply that to the outcomes that you expect, take the sum of that, you've got the expected value method. The second approach that you have is called the most likely amount. So that's where you look at the single most likely amount. That generally applies, or it works better when you have a binary outcome. For example, if the contract calls for a performance penalty or a performance bonus, you're either going to earn that bonus or you're not going to earn it. So that's what I mean by a binary outcome. Okay. Now, the way the standard is written, you're expected to select from the expected value and the most likely amount method, whichever gives you the highest predictability. So which is more appropriate depends on the ability of that method to tell you what you're likely to earn from that particular transaction or that set of transactions. Okay, now we can move on then to our next slide, and the board also says that you have to use these two methods, and the way you apply them is you think about two characteristics. You need to have your own historical experience with respect to the likelihood of the different outcomes. If you don't have your own historical experience, then the issue becomes whether you have access to the experience of others. One simple way I can tell you about that is, let's say that you are a seasoned retailer. You have a pretty good idea of who your customers are, and you have a sense of how many of them are going to pay the amounts that that you've loaned them to buy your goods and services. In other words, you have a pretty good sense of what their credit histories are and therefore the likelihood of paying. If you don't have a lot of experience with that, you could look at Dun & Bradstreet or some other source of credit history to determine what the likelihood of that customer being able to pay. Please keep in mind, of course, you can also use an assessment on the basis of a portfolio of similar customers. But the point is that you need some level of historical experience, either your own and or that of others. The second characteristic that's very important is that of predictability. So the experience that you have should be a very good indicator of the likelihood that the customer will pay. So Dun & Bradstreet, having been around for a very long time, for example, has a pretty good record. That's the kind of thing you're looking at. So please keep in mind, there are two things. One is the historical experience or the evidence, and the second is the predictive ability within that evidence that matters. Now, the board says that you have to look at various factors to evaluate the historical experience that you've gathered and to assess the predictability. Now, what are the factors that will have an impact on the predictability? So let's look at the next slide then. And this is where, on the next slide, I give you some of the factors. So the first factor that I want to think about is the degree of control the entity has over the possible outcomes. So for example, think about where you give rebates and refunds. If you're fairly permissive about the rebates and refunds that you offer, then clearly the range of outcomes and the control that you have is fairly, the range is very large and the control you have isn't very high. So for example, I remember the first job I had was a company that made a certain kind of engine, and we had 3 reasons for which you could get a replacement within the first 60 days. That was controlled. So in that sense, the control we had over the exchange and therefore the refunds was significantly high. That's what we're looking for. That's one of the factors. The second is the paucity of evidence or the amount of evidence. The more evidence you have, the more years you've looked at this particular business, the higher the likelihood that you can have a good forecast. I mean, this is like anything else. Look at, with what's happening with COVID-19. The more data we have, the more understanding we have of what's going on. And where the clusters are, the more evidence we have, the better we can trace them, that sort of thing. So the evidence, the amount of the evidence you have matters. The third is the degree to which the evidence can tell you whether the customer will take a discount, a rebate, or you will offer them a refund, etc. So that the third characteristic or criterion, if you wish, has to do with prediction, with the ability to predict what's going to happen to the amount you expect to get from your customers. So those are the first three factors. The next slide talks about the next three. And then there, what we're talking about is the uncertainty with respect to the outcome, or in other words, the amount of the consideration. If it's going to take a long time to resolve, so the longer the customer has to pay, the longer the customer can get rebates, refunds, etc., the less likely it is that you can develop reliable estimates of how much you're going to make. The next possibility then is the issue that we look at is that if we have a practice of offering concessions, if the seller has a practice of offering a large number of concessions, then you don't know how many concessions you're going to have, and therefore, again, you don't know how much revenue you're going to generate. The final factor that we've listed here is if there's a wide range of transaction prices. So if you're willing to accept different transaction prices, then that also affects your ability to determine how much you're going to get as revenue for that particular transaction. Now, I want to point out that, although I've gone through 6 factors and these are listed by the board, it doesn't imply that these are all the factors. So other factors may exist, and those are a function of the type of business you're in, the geography in which you're operating, the types of customers you have. For example, if you're selling to large businesses versus individual end users, there is going to be a difference in collectability. There is going to be a difference in credit quality there, right? So you have to keep those kinds of things in mind. So the type of customer matters, the geography matters, the type of product or service matters, right? For example, certain things get used within a very short period of time, certain products and services. Other products and services may take a very long time to be resolved. So that, of course, always makes a difference in the numbers that you expect to see. So these are good criteria to keep in mind, but it's also important to keep in mind that we haven't specified everything here. So your analysis as a seller, your analysis of variability should keep in mind the product or the service you're looking at, the types of customers you have, the distribution channels you use, the geography, the vertical into which you're selling, and so on. So all of those issues matter. Okay, then we can move on to our next slide. So what the next slide tells us is that although you're supposed to develop an estimate, and that estimate is affected by the amount of evidence, the quality of evidence you have, the predictive ability that you have with that evidence, and subject to the factors we've talked about, there is still one other component to keep in mind, and that is there's a constraint on the transaction price. So whenever there is a variable consideration, the board imposes a constraint, and that constraint in effect says that at any given point in time, the amount of revenue you've recognized for variable revenue streams is limited to the amount that you expect to earn as of that point in time. And effectively what that means is that there should not be a significant likelihood of a reversal in the amount of revenue you've recognized. And those of you who are familiar with 606 will recognize this because this issue of a significant reversal of the amount of revenue you've recognized shows up in many, many different places in our new revenue model. The whole objective is try to ensure that you don't have a significant likelihood of reversal. So please keep in mind that not only do you have to develop an estimate, but there's a constraint on that estimate. And then what I'd like to point out is that the board then goes on, for example, not for example, sorry, in paragraph 32-14, and remember it's 606-10-32, which means we're still in measurement. And what 32-14 tells us is something very important. Not only do you need an estimate, that estimate is constrained, as we just said. In addition to that, at the end of each reporting period, for publicly traded companies, that means at least at the end of each quarter, whether it's a calendar quarter or a fiscal quarter, doesn't matter, but at the end of the quarter, you have to update your estimate. So reassessment is required. So please keep in mind, once you determine that you have a variable revenue stream, you have to estimate it. You have to be cognizant and take into account several factors. You need sufficient evidence with sufficient predictability. Once you've done that, keep in mind there's a constraint. You can't recognize a portion that you expect with a high likelihood that it'll be reversed. After you make all those adjustments, come up with a reasonable amount, you now have an additional issue, and that is at the end of each quarter, you're going to reassess it. Okay, so that's how we work with variable revenue streams. And that, Ian, brings us to our next polling question.
That's right. This one is a little bit different. Simply your company's level of automation in revenue recognition. I'll just go ahead and I'll launch the poll. But like I mentioned before, SOFTRAX has a long track record of helping companies to automate their revenue recognition, and Tony as well is certainly an expert on this. So the poll is launched.
Great. So do you want to tell them about it? Do you want me to tell them about it? Or we want to chat about it a little bit?
Yeah, certainly. I mean, this is always an interesting one. We've asked this several times in the past, and what we don't have, we haven't asked in a few months, so we don't have any interesting time series data like you pulled up for our first polling question. But I mean, there is a pretty clear trend. A lot of companies seem to have adopted revenue recognition guidance, and they are compliant. But a lot of times that, and Tony, I'm interested in your experience with this. A lot of times, especially with regards to complex RevRec with 606, it's not an automated process. It's a largely automated process with a lot of spreadsheets that tend to be quite painful. I don't know if you've had the same experience.
Yes, I have. In fact, an interesting fact is that there are companies that with fairly complex revenue streams that continue to use spreadsheets. And, our audience, I'm sure everybody's aware of some of the audit issues that arise with respect to spreadsheets and so on, the reliability of those spreadsheets, the amount of control there is on those spreadsheets and so on. So the automation of revenue reporting is a critical component. It brings with it significant benefits, and therefore, not only from an external audit perspective, from a reliability perspective, but also from the ease of use. And yet we do see a large number. This is a question that in some form or the other that I've been asking for quite a few months now in my webcasts. And so it'll be interesting to see what this particular audience says.
Right.
So let's take a look.
And it looks like we are over 90% now, so I'll go ahead and close the poll in just another few seconds. And it's interesting. It looks like we have a couple of clear trends here. So I'll close. And Tony, what we're looking at is 7% of our attendees answered they are 100% automated. And 52% said that they're 80% with some spreadsheets and customizations worked in. 10% answered they're 50-50, and 31% said they're less than 50% automated.
Very interesting. So, as we expected, a significant percentage of our audience continues to use spreadsheets with some level of automation. So, yes, I think that's in keeping with what we've observed in the past.
Agreed.
Very good. So, Ian, I suppose you should be hearing from that 80% then. So,
I guess you're right. A SOFTRAX plugin here.
Well, we can.
And if you need help with implementation, then Tony is your man.
We always, we can always ask people to think about it. That's the best we can do, and provide them with good reasons to think about it. So that's all we're doing here. Very good. So that helps. That's useful information. Let's move on then, shall we, to our next slide. And Ian, what I was thinking is that before I talk about what's in the slide, I'll just mention briefly what we talked about the last time. So if you recall, I said that there are, broadly speaking, two methods for assessing variable revenue streams, or if you want to think about it in the board's language, variable consideration. And the two methods that I talked about are the expected value method and the most likely outcome. And I was just thinking back to some of my clients, one of whom I was talking to just last week. There is a third category, and that is revenue streams that are based on usage or sales. So, for example, somebody accesses the seller's IP and then embeds it in a product or service that they provide to their customers. So and then they pay you, the seller of the IP, they pay you on the basis of the number of units in which they've embedded your IP. So that's sales-based. Or sometimes what happens is that it's usage-based, where they're using your IP to provide certain services. So, for example, you have tax filing software, and a local CPA firm uses your tax filing software, and they pay you on the number of tax returns they generate. Similarly, HR software paid on the basis of the number of payrolls that have been completed using your software. So there can be sales-based and usage-based variable consideration. However, in general, and maybe for most of sales and usage-based sales and usage-based revenues, you're not permitted to use either of these two methods, the expected value and the most likely outcome. You can't use them. In fact, for sales-based and usage-based revenue streams, you can only recognize revenue at the later of two events, one of which is your transfer of the IP. Now, generally speaking, if you have customers who are going to sell products based on your IP, or they're going to use your IP, that transfer of the IP occurs on day one. Transfer of the software occurs on day one, right? The second possibility is when the actual sales or usage occurs. So you can only do it at the later of those two. So for the majority of companies whose revenues are based on sales or usage, they can only recognize revenue when those sales or that usage occurs. So they're not allowed to use these two methods. There is one condition under which you may be able to use these two methods for sales and usage-based revenue streams, but then your IP would have to be embedded within a product or service which right? That product or service is not, or rather, your IP is not the primary component of that service. So it's a very limited condition under which you can use the expected value or the most likely outcome for sales and usage-based revenue streams. So that's why what we decided, SOFTRAX and I decided, is that we're going to focus on the variable revenue streams, these other two, the expected value and the most likely. April 28th, that webcast focused on the expected value method, variable revenue streams. Today, we're going to focus on the single most likely outcome. Now, generally speaking, as I described earlier, the single most likely outcome method can be used in a variable revenue stream where there are basically two outcomes that are possible. There may be a few outcomes, but generally speaking, only two. Either you're going to earn a performance bonus or you're not going to earn it. And you could have a single performance bonus. But I could also, and I have seen contracts where the performance bonus says something like this. Okay, so we're engaging you to develop some customized software for us. If you finish within 4 months, we'll give you a bonus of $25,000. If it takes you 5 months, the bonus falls to $20,000. If it takes you 6 months, the bonus falls to $10,000. But if it takes you 8 months, then you actually get a reduction of $10,000 in the fixed fee, right? So in that sense, what happens is that you're really looking at two very different things, right? Either there's a binary possibility or there are a few outcomes like 4 or 5. But more often than not, the most likely outcome is, generally speaking, binary. But we can handle both of them. Now, there is in the basis for conclusions to the accounting standard itself, to ASU 2014-09, which was the original 606. Right? Since then, there have been many accounting standards updates, but that original 606, there was a basis for conclusions in which the board made it very clear that they don't expect you to look at every single outcome that could be a possibility in applying the most likely. But of course, if there are only two possibilities, then you're going to look at both, right? So the question is, which is the most likely? So that, to give you a background on what the most likely outcome method means, I wanted to provide some additional information, and that's what we've done. Now let's move on to our next slide then. Okay, and this is where I give you the actual example. Okay, now you have to be, take a look at this and with some care. Notice what I've said is that on January 1, 2020, you're a software developer and you've entered into an agreement with a customer, an existing customer. So let's assume for a moment that that customer was using your revenue automation software already, right? They're a customer of yours, they're using that, and they come in, and for the last couple of months, you've been negotiating with them. What they want you to do is build an additional feature which will sit on top of your automation software. It'll talk to your software. It'll use the data that your software is generating, and it'll allow the customer to do financial planning and analysis. So it's an FP&A add-on, let's say. And you agree to customize that additional functionality for them, and the customer agrees to pay you a certain amount. And you agree that you will do it, you'll complete the work within 5 months. But then to give you a little incentive, the customer says that if you do complete it within 4 months, we'll give you an additional amount. So let's assume that the fixed fee is $100,000 and the early completion bonus is $20,000. So you could make $120,000. Now, this is the example where there's a binary outcome. Because if you don't finish it within 4 months, then you're only going to get 100,000. If you do finish it within 4 months, you'll get 120,000. And let's say that you have developed and customized features and maybe even similar features for a reasonable number of customers in the past. So your developers are fairly confident that they can complete this work within 4 months. And as a result, the single most likely outcome is that you will earn the $20,000, the bonus. Consequently, you decide that your transaction price should include the $20,000, and therefore your total transaction price is $120,000. So that's a very straightforward application of this, right? So you enter into this agreement on the 1st of January 2020, and what you're doing is you're agreeing to complete this, and you think you can complete the development and it'll meet the specifications of the customer, and all of this will be agreed to and settled by the end of the 4th month. So in other words, we're looking at the 30th of April, right, for the completion. Now, one other thing I want to add over here is that our quarter end is the 29th of February. Okay, so we can move on then to our next slide, please. All right, so this adds a little bit more information than some of it I've already given you, right? Okay, and actually just about all of it. Right? So yeah, there's just a little bit more, and the idea is that since you agreed to develop this one feature, it's a single performance obligation, and we analyze this single performance obligation, and we decide that this is going to be, the service is going to be provided over time. Now, what do I mean by that? In other words, what we've done is we've said that this feature requires certain things that it can do. We can split those up into, say, 4 milestones in a way. And we can reach each of those, and each of those milestones will constitute, and just to keep it simple, let's say, when we finish the first one, then it can do 25% of what it's supposed to do. When we finish the second one, it's 50% of what we expect it to be able to do, and so on. So effectively, keeping that in mind, and keep in mind what we've also said is that we've reached agreement with the customer on all of this, right? Okay. So that allows us to move on to our next slide. Okay. So, and what I want to do here is just basically provide, I mean, you can see the materials up there, but I wanted to say that you begin work on the 1st of January, or developers begin work. On the 31st of January, they have already informed you that they've met and completed what was supposed to be done at the end of the first month, and they have reached the first milestone. It's successfully tested, the customer has agreed to it, and all is done. So you take 25% of the total revenue. So out of the 120,000, you recognize 30,000. You get to the end of February 29th, same thing. The second milestone has been reached, specifications tested, you have acceptance from the customer, you recognize another 30,000 for the month of February, you got 60,000 out of the 120. Now at this point, COVID-19 hasn't affected too many things. People are still going to work. The shelter-in-place orders have not. By the way, did you know that there are at least one winery that I know is using the acronym SIP to give you a 20% discount if you order from them And the SIP in that case does not stand for sipping wine, it stands for shelter in place. Just as an aside. People are pretty clever. So yeah, I thought it was pretty nice, the shelter in place standing for SIP and for SIP. Okay.
I'm sure the winery's doing okay in business.
Yes,
Sure the orders haven't fallen.
they make very good wines. So I certainly hope they'll be able to survive. So here we have, we're at the end of February, as I said, not much. But then along comes March. Or, by the middle of March, the shelter-in-place orders are out there. Most companies, if not all of them, are adhering to them. The transmission problems are clear and so on. And towards the end of March, the developers tell you that they are behind. Okay, they haven't reached the third milestone. And, remember, you have to reassess at the end of each reporting period. So clearly, I would argue that at the end of February, you did not have a problem with the estimate of 60,000. But at the end of March, it certainly looks like you cannot say that you've got another 30,000. Right? Because you haven't reached that, you haven't been able to do the testing, well, you haven't completed the specs, and you haven't reached the third milestone. So in that sense, I think that it does create a problem for this variable revenue stream. Now, the way I structured this, clearly it doesn't affect the 60,000. But now you have a really serious problem because, in the sense, or at least you have a question. Maybe I shouldn't have said serious, but we can deal with that. So what you have to do is ask yourself at the end of March, with the delays, and at the end of March, you also do not have a great deal of visibility into when you're going to come out of this. So therefore, clearly you cannot add another 30,000. But the question is whether at the end of March, it raises the likelihood that you will not be able to finish everything by the end of April. So you're already behind. And you expected to do a quarter of the work in the month of April, but that quarter that you expected to do in March is not done yet. And if it's not done, then it may bring with it some problems that would really delay the April. So now the question becomes, at the end of March or sometime during April, do you have the likelihood that you're not going to make the deadline of April 30? And you will not be able to complete this feature by the end of April and get the acceptance from your customer. So the problem therefore becomes that there is some chance, there's some uncertainty, and maybe a significant amount of uncertainty that you cannot complete this by the end of April. So that raises the question of the first 60,000, but even more importantly, it raises a question of what to do about the 20,000 itself. You see, the problem we have now is that if we don't get to the deadline by the end of month 4, then we're not going to earn the 20,000. So if you stay with that set of assumptions and that debate, discussion in a sense, those different characteristics, then you have to ask yourself, it certainly seems possible at the end of March and early April even, and even by the end of April, that it's unlikely that you're going to meet this standard that the specs that you need to and so on, you won't be able to complete it. If that's the case, then chances are you're not going to earn the 20,000. Now let's think a little bit about what the boards have said in the guidance that they've provided. Admittedly, the guidance they've provided was not for variable revenue streams. It was for rent concessions offered by lessors to lessees. And what the FASB said was that don't treat it as a lease modification. Effectively, what the board said is that the pandemic, COVID-19, is a temporary dislocation. And a lease modification really is only required by the standard when the economics of the transaction change. And therefore, if you get 3 or 4 months of rent that you don't have to pay right now but pay later, it doesn't affect it that much, so don't change anything. The IASB, on the other hand, for rent concessions is saying, find the amount of an impact it has on the leased asset and the lease liability, and show that adjustment as part of your beginning retained earnings. So even though it's treated as a temporary dislocation, even by the IASB, they're effectively what the IASB is doing is amending their standard. The FASB is not amending their leasing standard. So there are some very interesting differences there. Our problem here is that when you look at this most likely outcome scenario, there it seems very hard to argue that we can get things done by the end of April 30th. So if I leave it there, I think it's fair to say that you have a problem with respect to that $20,000 performance bonus. However, I think it's completely fair to think about one other issue, and that is your customer is likely to accept and understand the fact that there is a dislocation due to COVID-19, due to the pandemic, due to the uncertainty caused by the pandemic. So it's possible that your customer would agree to extend the amount of time that you have and not eliminate the bonus. In other words, instead of holding you to April 30th, they might say, okay, we'll give you until May 31 or June 30 or something like that. In other words, you could negotiate a change, and the negotiated change in the deadline for the performance bonus could be such that you don't have a problem with your revenue recognition. But that's what you have to think about, right? Is it going to be possible to negotiate a change? And, you know, I fully expect that you've already been talking to the customer in this case, right? So that's what I wanted to look at initially, and those are the possibilities in case A. Now, and that's discussed also on the next slide. And I'd like to move on one more slide and get to case B. And what I say in case B is that instead of agreeing with the customer that you'll complete the functionality and have the feature functionality ready in 4 months, you actually have a whole year to complete it. Now, you go back into your history, look at the amount of work required for this feature, and let's assume you decide that a year is sufficient to complete it, and therefore you think the most likely outcome is that you'll earn the performance bonus. Now, if I keep the contract date, the inception of the contract, at the 1st of January, then I still have the same, you know, I come down to February 29th. I've taken some portion of the additional revenue that I expect for the performance bonus because I'm including the performance bonus in my transaction price, right? So effectively what happens is that everything I did up to the end of February 29th is correct. March and April tell me more about COVID-19. I am informed of the delay, but now remember, I have a whole year to finish this. And if I have a whole year to finish this or 8 months to finish it, then, you know, that changes the calculus to some extent. And I could easily argue that if you have a sufficient amount of time, then the dislocation of March and April and now all the way into today, the 26th of May, and for all intents and purposes, you know, May is about done. So you know how much of a delay you've had March through the end of May. and therefore you could reassess. And once management of the seller has reassessed how long it's going to take development, and they've decided whether they can complete it within the year or not, at that point they could go to the customer and start negotiating for any changes. But keep in mind, what I've done here is, particularly in this most likely outcome argument, effectively what happens is that if the performance bonus was to be determined by the end of March or by the end of April or the end of May, then chances are that unless there's flexibility from the customer side, you're not going to be able to do it. And you have a problem with the amount you already recognize. Assuming there's flexibility from the customer side, you may not have a problem with having included the variable consideration in your transaction price. The entire argument changes if I go to the point where I'm saying I had more than 4 or 5 months to do it. If I had the entire year to complete, then I have a little more time, a little more luxury in a sense to make up for the fact that I've fallen behind in March and April, right? So that is what I wanted to tell you about cases A and B, and now I have some software implications, right? And what I wanted to tell you about the software implications, and the software implications, Ian, I missed that title there. In the title, it shouldn't say case A because the implications are for both. Anyway, hopefully it's not a big deal. Here's the thing with respect to the software, or whatever it is that you're using. So we should address what the 80% are doing as well. Here's the thing. Remember that whether you use the expected value method or the most likely outcome method, you're still looking at what your past experience has been. You're still looking for what your predictive ability was with respect to that past experience. So my recommendation always has been to track these different transactions, the different contracts, where you've been developing similar features, for example, or providing similar sliding scale discounts if you go back to the expected value method. So the idea is that you've been collecting data, you've been analyzing that data, either in a spreadsheet or preferably in software, but you've been analyzing that data. You've been looking at the historical record that you had. And the question becomes, right, this one, there's a disruption. You're not going to finish in the 4 months. It might take you 5 or 6 months to finish. Now the question becomes how much weight to put on this particular transaction's inconsistent results. They're inconsistent with prior results. So effectively what happens that instead of finishing within 3 months, 3.5 months, or 4 months, it took us more than 4 months. So now what management needs to do is think about how much weight to put on the consequences of the delays caused by this pandemic. So really what it does is you have to start thinking about how it affects your data collection, how it affects your documentation, how it affects your analysis, and then how it affects your conclusions. Right? So this is a step-by-step, very careful process that you need to think about. And please keep in mind, this is something you need to do with respect to a lot of other items on your financial statements, because your variable revenue streams are not the only thing affected. Collectibility is going to change. Customers that you signed up in the last 6 months, they are experiencing other issues with their revenue. So their ability to pay may have changed. So collectibility going forward is affected by COVID-19. Well, that you don't need me to tell you. You can see the evidence. In the last few days, we've seen J. Crew announce bankruptcy. A couple of other retailers are in fairly difficult states. Hertz, the car rental company, has announced bankruptcy. So, those kinds of things are going on, and these are consequences, at least in part, of COVID-19. Airbnb has reduced its workforce and operations by about 30%. Uber has reduced the number of people working for it, so on. So these examples are all out there. You can look at those, you can see what the companies are saying about them, learn from those, and then hopefully what we've said on April 28th and today will also help you think about variable revenue streams. And I think that, Ian, should bring us to our last polling question.
I was going to say we're running up right against the end, so I'll go ahead and I'll launch the final polling question just so everyone can get it in, and then we can do some sort of housekeeping stuff towards the end. But that should be live.
Great.
Feel free to answer how that apply.
Yeah, it's a fairly straightforward one, so we don't need to talk very much about it. Do we have any questions you want to ask, or do we just need to do some housekeeping?
I think we're right up against the end, so I think that what might be a better idea is if we can follow up with the questions via email.
Okay.
If that's all right with you.
Yeah, I'll be happy to get back to people, and we'll do that. So go ahead and let's take care of any housekeeping that we have. Let's remind people not to close out until they've done all this stuff and whatever else you need for them to make sure they get their CPE.
Yes, absolutely. So thank you guys all for voting. I see that most of the responses are in for this poll right here. So I'll go ahead and I'll close that. And like I said, I want to be sensitive of time. But once I go ahead and I end this broadcast, then there will be a short 5-question survey that comes up within the GoToWebinar console immediately after. So if you could answer that in addition, just for your feedback as far as the learning objectives against the CPE requirements, that would be very helpful for us. And right here, we have sort of a quick illustration on the past results of this question. This will be available as a replay, though, so we can sort of get into more of that data after the fact. Yeah, feel free if you're interested to take a look. What else we have? Tony, I'm not sure if you want to say a brief word about your consulting services coming up. Looks like you have.
Yeah, thank you. Yeah, if people want to talk about, how COVID-19 affects their issues, I have been talking to some clients about that, and I'm happy to do that. And I'll leave it there just in case there's anything else you need, Ian, to tell people about so that we don't miss any. But there's all the information there that people can get in touch. So
yes,
I
absolutely.
Look forward to that. And
yep. So Tony, thank you for your time. We appreciate it. To everyone who attended, thank you very much for your time. I'll be reaching out via email with your CPE certificates and, again, to answer any questions that may have come up. If anything comes up in the meantime, you can see my contact information here. So feel free to reach out, regardless what the questions are. And like I said, if you could answer this survey that comes up, again, immediately after the broadcast is ended, that would be very helpful. Thank you very much for your attendance. And from Tony and I, from the SOFTRAX team, from A.C. Sondhi and Associates, we hope you have a great afternoon.
Thank you, Ian.
Thank you very much, Tony. Thanks, everybody.